Everyone's feeling bullish. Markets are climbing. Tech stocks are soaring. Optimism is echoing across Wall Street and social media feeds. Yet, while the crowd celebrates and pours money into the market, Warren Buffett, the world's most iconic value investor, is quietly cashing out. This quarter alone, he sold over $4 billion in stocks. And this isn't some random rebalancing. When Buffett sells, he's not reacting to noise. He's signaling something deeper, not a crash, but a repositioning, a recalibration for what survives after the hype fades. And that's the real story here. While others are playing the short-term game, Buffett is setting the stage for his next big move. If you're serious about learning how one of the most successful investors in history is preparing for what's coming, not just reacting to what's happening, this is the video you cannot afford to miss. Before we dive into the companies Buffett sold, let's pause here for just a second. If you're getting value from this breakdown already, make sure you're subscribed to the channel. Hit that like button so this message reaches others who care about long-term wealth, not short-term hype. Let's zoom out. Buffett's moves this quarter are not a fluke. They're part of a long-standing rhythm. For over 60 years, he has followed a timeless principle. Buy great businesses at fair prices. Sell only when the valuation outpaces fundamentals. That's exactly what we're seeing now. Berkshire Hathaway, Buffett's investment vehicle, is sitting on over $340 billion in cash. Why? Because Buffett knows how to wait. When the market overheats, he trims. When it cools down, he strikes. He's not guessing the next Fed decision. He's not glued to inflation headlines. He's watching valuations and reacting only when the price no longer justifies a risk. Buffett's brilliance isn't in predicting. It's in discipline. He doesn't need to be right about tomorrow. He just needs to know when the risk-reward equation stops working. And this quarter, that equation broke for several key holdings. Let's talk Apple. Between 2022 and 2024, Buffett trimmed billions in Apple shares, even though the stock kept rising. Why would he sell his most profitable position? Simple. Apple's weight in his portfolio became too large. The valuation ballooned. Risk management, not panic, guided his decision. Now, in Q1 2025, we're seeing the same logic play out again, across multiple sectors. Buffett sold over $4.35 billion in just a few months, not because he fears a crash, but because he no longer sees adequate return for the risk. This isn't fear, it's precision. Let's break down what he sold, and more importantly, why. Red triangle pointed down major sell number 1. Citigroup, entire position exited. Berkshire Hathaway sold all 14.66 million shares, worth around $1.1 billion. This wasn't a surprise for those tracking Citigroup closely. Its return on equity hovers around 6%, far below competitors like J.P. Morgan. Despite hopes of a turnaround, Citigroup never delivered the kind of operational efficiency Buffett bets on. The bank's efficiency ratio, the amount it spends to generate revenue, remained above 60%, signaling weak profitability. Buffett stepped in during a dip in 2022. The turnaround he expected never arrived, so he exited. Red triangle pointed down major sell number 2, New Holdings, a fintech dream that faded. Buffett completely exited this Brazilian digital bank, selling 40 million shares, worth around $482 million. Originally seen as a bold bet on financial inclusion in Latin America, New Holdings promised explosive growth, but fundamentals never followed. Operating income plateaued. Inflation in key markets like Brazil and Mexico made profitability elusive. Its forward PE ratio at the time of sale hovered around 24x, down from a sky-high 70x, but still rich for a fintech in emerging markets. Buffett cut his losses, not because the dream was wrong, but because the math stopped adding up. Red triangle pointed down major trim. Bank of America, $2.1 billion sold. Buffett has long loved Bank of America, but this quarter he sold 48.6 million shares, worth roughly $2.1 billion. The reasons? Shrinking net interest margins as rate hikes stabilize, concerns over consumer debt and commercial real estate exposure, a slowing growth outlook in the short term. It wasn't a total exit, but a signal. Buffett is reducing exposure to banks that may struggle in a maturing rate environment. Red triangle pointed down, hidden trim. Liberty Media Formula One, $317 million sold. Formula One's media expansion brought a wave of popularity and valuation, but growth has plateaued and monetization isn't keeping up with rising expectations. Buffett sold 3.3 million shares. Why? The PE near 40x, heavy debt load, and vulnerability to economic slowdowns no longer made attractive. He took profits on a brand that stopped compounding at the pace he wanted. Red triangle pointed down, other quiet trims. T-Mobile, 466,000 shares sold, $113M. Growth is slowing. PE remains high. Buffett doesn't cling to slowing momentum plays. Capital One, 300,000 shares sold, $56.7M. Credit card delinquency is rising as household debt hits record highs. A cautious step away from consumer credit risk. When you line these up, the pattern is clear. Buffett is cutting back on financials, Citigroup, Capital One, Bank of America. Fintech exposure, new holdings. Media and telecom with high valuations and slowing growth, Liberty F1, T-Mobile. He's not running from markets. He's reallocating to opportunity. And if there's one thing Buffett has always done better than almost anyone, it's this. He sells when others are greedy. He holds cash while others chase headlines. And when opportunity returns, he strikes big. So ask yourself, in a time when everyone is buying, are you watching what Buffett is preparing for? Before we jump into what he bought and what it reveals about where the smart money is headed, let me ask you something. Which of Buffett's sells surprised you the most? Drop it in the comments. Your take might open someone else's eyes to a deeper pattern in the market. While headlines focus on Buffett's $4.35 billion in stock sales, very few people notice where that capital went. But if you know anything about Warren Buffett, you know he doesn't just raise cash to let it sit idle. He's preparing for something. And what he's buying now gives us a rare window into how he sees the next phase of the market playing out. Let's break down where the Oracle of Omaha is placing his bets and why. White heavy checkmark new buy. Constellation Brands, $1.17 billion invested. Buffett added over 6.3 million shares of this powerhouse alcohol company, behind names like Corona, Modelo, and Robert Mondavi. Why? Strong operating margins. Constellation's beer division runs at 34%, one of the best in the industry. Consumer resilience. Even in slow economies, people still buy beer and wine. Valuation discipline. The stock trades at AP of 14, well below consumer staples peers. This is classic Buffett. Buy brands with pricing power, sticky demand, and stable cash flow, especially when others are distracted by flashier plays. White heavy checkmark energy bet. Occidental Petroleum, 763,000 shares added. Buffett now owns nearly 28% of the company. Why is he doubling down? Over $4 billion in free cash flow last year. Strong debt reduction and reinvestment strategy. A hedge against inflation and energy instability. Occidental isn't just about oil. It's about energy security and capital discipline. Two things Buffett deeply values in uncertain times. White heavy checkmark contrarian play. Sirius XM, $58.8 million added. Sirius may seem outdated to some. The stock is down over 60% from its highs. But beneath the surface, over $1 billion in annual free cash flow. High-margin subscription revenue, a model that's slow-moving but incredibly sticky. This is a contrarian cash machine. And Buffett has a long history of buying unloved businesses that the market has written off too soon. White heavy checkmark quiet growth engine. Domino's Pizza, $113 million added. Buffett bought 238,000 shares of Domino's. Why pizza? Because Domino's is no longer just fast food. It's a logistics company with global digital infrastructure. Over 40% of orders are digital. International expansion is strong. Earnings are predictable. Brand loyalty is high. And in volatile markets, simple and scalable wins. White heavy checkmark hidden gem. Pool Corporation, $260 million invested. Pool Corp is the world's largest distributor of pool equipment and outdoor living products. Sounds niche? That's exactly why Buffett loves it. High repeat business, low competition, strong pricing power, steady EPS growth for over a decade. This isn't a company most investors are watching, but Buffett is. White heavy checkmark digital infrastructure, very sign small ad, big signal. He added 18,000 more shares of VeriSign, the operator of .com and .net domains. It's basically the plumbing of the internet. Close to 70% operating margin. Generates over $800 million in free cash flow annually. Long-term contracts and monopoly-like control. It's not exciting, but it's predictable. And predictability in uncertain times is Buffett's ultimate compass. Let's pause for a moment. Are you subscribed to the channel? You might be surprised. Most people watching right now never hit that subscribe button. Check now. Make sure you're subscribed and turn on notifications. That way, you won't miss insights like these. While others keep guessing, you'll be learning how the masters move. Back to it. Puzzle piece, what do all these buys have in common? They're not trendy. They're not the next big thing. They don't dominate headlines. But every one of them is a cash flow machine with high predictability, low volatility, and disciplined valuations. None of these trade at outrageous P/E ratios. Most operate in non-cyclical industries or niche markets. And all of them give Buffett what he values most: control, clarity, and capital efficiency. In a market filled with noise, Buffett is building a portfolio that whispers security. And when you piece it together, his portfolio says one thing loud and clear: the smart money is shifting. It's moving away from inflated tech, uncertain growth, and over-leveraged financials, and into boring, durable, undervalued cash producers. If that doesn't tell you something about what's coming next, I don't know what will. Now, let me ask you something. Is there someone you care about who might be following the noise while ignoring the signal? Send them this video. You could be the reason they pause before making a mistake. And start building wealth the Warren Buffett way. Now that we've examined what Warren Buffett sold and what he bought in Q1 2025, the next step is connecting the dots, understanding not just the trades, but the philosophy and the larger economic signals behind them. Because Buffett doesn't explain himself in press conferences. He speaks through capital allocation. So what's he telling us right now? Let's put the puzzle together. Brain step back, the strategy behind the shift. Buffett's recent moves aren't driven by panic. They're driven by valuation, discipline, and risk-to-reward math. When he sold Citi, New Holdings, and trimmed Bank of America, it wasn't because those businesses were crumbling. It was because they no longer met his standard for future returns. Remember, Buffett is a master of opportunity cost. Every dollar left in a bloated or underperforming asset is a dollar that could be working harder somewhere else. He didn't sell because he fears a collapse. He sold because he sees limited upside. And more importantly, he sees better options. Compass defensive positioning, not retreat. Buffett's current portfolio reads like a playbook for economic defense. Alcohol, Constellation Brands recession-resilient consumption. Energy, Occidental inflation protection plus geopolitical hedge. Digital media, Sirius XM cash flow plus contrarian upside. Infrastructure, VeriSign consistent performance. Digital backbone. Consumer staples, Domino's scalable, affordable indulgence. Outdoor living, Pool Corp niche high margin, low competition. He's not running from risk. He's rotating into businesses that can thrive even when the economy stumbles. Puzzle piece what the smart money knows that retail often misses. Here's what most casual investors miss. While many obsess over the next IPO, tech unicorn, or crypto bounce, Buffett is focused on something far more boring and far more powerful: durability. Ask yourself, how many of the companies in your portfolio could survive 10 years of economic turbulence? Buffett's are built for it. And more importantly, they're priced for it. He's not buying at the top. He's not chasing hype. He's waiting patiently for value and then moving decisively. This patience is his advantage, and it can be yours, too. Brick, what should retail investors learn from this? You might not have $340 billion in cash like Berkshire Hathaway, but the principles don't change. Here are 5 lessons you can apply today. Stop chasing headlines. If it's already hot, it's probably overpriced. Prioritize cash flow. Invest in businesses that generate, not just promise. Think in decades, not quarters. Play the long game. Buy what you understand. Simplicity beats sophistication when things get rough. Hold cash when necessary. Waiting is a strategy, not a weakness. Brain final thought. Buffett's silent message. Right now, the market feels confusing. Inflation numbers are softening, but not gone. Interest rates may fall, but debt levels are high. Growth is stalling, but asset prices are soaring. It's easy to feel paralyzed. But Buffett isn't confused. He's communicating a clear message, just not with words. Be greedy when others are fearful, and fearful when others are greedy. Right now, he's not chasing anything. He's quietly preparing, and that might be your signal to do the same. So tell me this, what part of Buffett's strategy surprised you the most? Leave a comment below and let's start a real conversation. You might just help someone see investing through a new lens. And if this breakdown gave you clarity, consider sharing it with a friend, because smart investing doesn't need to be loud. It just needs to be consistent.